When Tesla joined the S&P 500, index funds bought $80 billion of stock in a single day. The price spiked. Then it started drifting back down. That pattern repeats every time the index changes. Trillions in passive money forced to trade on a schedule everyone can see. Additions spike, removals drop, and both partially revert. The S&P 500 isn't a fixed list. A committee reviews membership and swaps companies in and out, usually 20 to 30 changes per year. When a stock gets added, every index fund tracking the benchmark has to buy it. That's over $9 trillion in passive assets as of 2025, all forced to rebalance on the same day. Removals work the same way in reverse. Forced selling pushes the price down, not because the business suddenly got worse, but because of mechanical rebalancing. Andre Schleifer showed in 1986 that demand curves for stocks slope downward. When index funds buy, they push the price up. When they sell, it drops. The price change has nothing to do with fundamentals. It's pure mechanical pressure. Harris and Gurl confirmed it the same year. Volume spikes on inclusion day, consistent with forced rebalancing. Chen, Noronha, and Singhal extended the work in 2004 and found an asymmetry. Additions show a permanent price increase, while removals show a temporary decline that partially recovers. The two sides behave differently, and that matters for implementation. Additions spike on forced buying, then partially revert. The initial pop is real, but some of it fades as the demand shock wears off. Removals drop on forced selling, then tend to recover. When a stock leaves the index, it isn't because the business deteriorated. It's often because market cap fell or an acquisition removed it. The forced selling creates an artificial price depression that corrects over time. Buying oversold removals may offer better risk-reward than chasing additions. The schedule is known in advance. The S&P 500 committee swaps 20 to 30 stocks per year, and every change is pre-announced. Front-runners have compressed the edge, but they haven't eliminated it. Tesla rallied 8.6% in the week before its inclusion as traders front-ran the index funds. On the effective date itself, the stock dropped 6.5%. That front-running pattern shows up across most additions. Let's see how to track these events as they happen. One SQL query, that's structured query language, shows every addition and removal from the last 12 months. The query is straightforward because the data table already pairs each swap. The historical S&P 500 constituent table tracks every S&P 500 change. Each row is one swap, a stock added and a stock removed. The tristorp time function parses the date because the raw data stores dates as text like June 2nd, 2000, and we need actual dates for filtering and sorting. Without that conversion, the database can't sort chronologically or apply the 365-day lookback. We're looking at the last 12 months. That gives us enough events to spot patterns without going too far into history. The S&P 500 typically sees 15 to 25 changes per year, so a 365-day window captures a full cycle. In the results, you'll see pairings. Every time a stock joins, another leaves. The committee doesn't change the total count, it's always 500. Stocks added within the last 5 trading days are in the peak event window, because the forced buying effect is strongest in the first week. Stocks added 21 or more days ago have largely worked through the mechanical price impact. Don't ignore the removed side. If a stock was removed recently and dropped sharply, it may be oversold from forced selling. The academic evidence says removals tend to recover. Look at the dates carefully. A stock removed in the last 5 trading days is still in the acute selling window, where index funds may not have finished unwinding their positions. A stock removed 3 or 4 weeks ago has already gone through the worst of the mechanical selling. If it's still trading below its pre-removal price, that discount might represent a genuine opportunity. Not all S&P 500 additions are equal, and the raw event list needs filtering to separate genuine demand shocks from pre-priced noise. The first filter is volume confirmation. Event day volume has to spike at least 50% above the 20-day average. This removes additions where buying was spread over multiple days or was already front-run before the effective date. A volume ratio above 2.0 means volume doubled on inclusion day, consistent with heavy index fund rebalancing. Without that volume spike, the market likely absorbed the change gradually, and the price adjusted smoothly with no overshoot to exploit. The second filter is a 5-day event window. The forced buying effect is strongest in the first 5 trading days after the change. Stocks added more than 21 days ago have largely worked through the mechanical price impact. Focusing on the fresh window captures the strongest signal. The third filter is tracking the removed side explicitly. Removals drop on forced selling, then tend to recover. Buying oversold removals may offer better risk-reward than chasing additions that have already been front-run. Every swap has two sides, and the contrarian side is often the more interesting one. This strategy has structural constraints that no filter can fix. Front-running compresses the edge. The S&P 500 committee pre-announces every change, and traders buy anticipated additions before the effective date. By the time index funds actually execute their forced buying, much of the move has already happened. Tesla rallied 8.6% in the week before inclusion. The alpha that remains after front-runners take their cut is smaller than the academic papers suggest. The gap between announcement and effective date is typically 5 to 7 business days. Professional traders start buying within hours of the announcement, and by the effective date, most of the price adjustment has already happened. Weight in the index matters more than the event itself. A $500 billion company joining the S&P 500 creates massive forced buying pressure. A $10 billion company joining creates a fraction of that demand. The screen treats all additions equally, but the price impact is proportional to the weight the stock will carry in the index. Small weight additions may produce no detectable signal at all. This only applies to the S&P 500. Off-cycle changes driven by mergers and acquisitions behave differently from scheduled quarterly reviews. Other indices like the Russell 2000 have their own reconstitution dynamics, but the data here covers only S&P 500 constituent changes. Generalizing to broader markets without separate testing would be a mistake. That's the index reconstitution strategy. Trillions in passive money forced to rebalance on a predictable schedule, with additions spiking and removals dropping in patterns that have persisted for decades. The SQL query is live on CetaResearch.com. You can adjust the lookback window, filter for specific additions or removals, and cross-reference with price data. Link in the description. The full backtest is next. Every S&P 500 addition and removal since 2000 tested across 25 years of data. Does the effect hold after front running? Subscribe so you don't miss it.